Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday the 1st of April 2022. And as always, this is general commentary and doesn't take your personal situation into account. Well, with all that said, let's go straight to our first chart. Well, I've got the chart of the S&P 500 in front of us. And really, what a couple of weeks we've had. So how's this for a combination? We've had a rate hike and we've had a stock market rally. Now, that's not a combination a lot of people were expecting. And we know a lot of people weren't expecting this because of all the hedging activity we were seeing as the market was down here. We had a look at some charts recently about all the volume that had been going through those inverse market ETFs. There'd been a lot of put buying, there's a lot of fear, there's a lot of concern the market was going to crash. And this so often happens at important turning points. We get people going out there hedging, getting short, and then you know what happens? The market does the opposite, goes the other way. And I've seen this happen so many times before. And I think that's really what's been happening here. I think what we've been seeing through here, this is really a classic short covering rally. And we've seen the market put on, well, from these lows through to the high a couple of days ago, put on 12%. And if you just look through here, there are only really a couple of down days in this whole rally. So it ranks as one of the strongest rallies which you're going to see in a market. Typically these happens after some sort of a low point, as the market does exactly what it's been doing, short covering, and that's how powerful these rallies can be. And it's really about all that pent up energy which was put in place down here, all that negativity, and what that's resulted in is the market slingshotting in the opposite direction. And look, I think it's really interesting to look at this and think about how all this has come about. Because like we were talking about the potential of this. Oh, look, I think it was 3 weeks ago. It was actually 3 weeks ago we started talking about the possibility of I was talking about a 5 to 10% rally. And so what we can do, one of the big thing we were talking about was this bullish wedge formation which started to appear on the charts. So 3 weeks back, I think it was around about here. It would have been around here that we started talking about, well, look, could this be a bullish wedge forming? And we started looking at it. We started talking about the possibilities. And it just goes to show, it shows the value of looking at charts in trying to analyze the market and put together the possibilities of where things could be going. Because this pattern here, it really did help identify the shift in conditions that was happening here. Because like the whole theory of the bullish wedge is that as the price starts to contract within the range, the market's really starting to lose its downward momentum. The energy behind the momentum is starting to dissipate. Now, these patterns, they can sometimes accelerate to the downside, but more often than not, you find they do lose steam and you get this snapback in the other direction. So, this is one of the great things of charts, not just bullish wedges, but charts in general, because they help identify the conditions and changes in conditions, and they help map out possibilities. And we have been speaking over the we were speaking 3 weeks about the possibility of the market could collapse, or you could get this short covering rally. And we had strategies in place if the market collapsed. They're our exit stops. But unlike a lot of people who got themselves so heavily hedged, fearing the worst, if you've been using trailing stops, risk management strategies, you've kept yourself in the game with the market rallying. And so look, it's always interesting to reflect on this through the charts and get your ideas on how you can manage and play out these situations. So look, the question now is, where to from here? Where are these markets going next? And I think what we have at the moment, I think we have a market which has gone too far. So 12% in 2 weeks, that's a cracking rally, and that pace of advance is just not going to continue. We can be pretty certain of that. And I think what we're going to see now, well, I think maybe we've already started to see it just overnight on Thursday in the US. I think we're starting to see signs of a pullback. Now, I'm not expecting that we're going to get a retest of these lows down here anytime soon. That's a possibility, maybe a month or two or three out, but it's not the scenario I'm looking for at the moment. I think look, let's put some Fibonacci's on. That they're always good to give us an idea of where a pullback could come to. So we use the low point from the latest rally, and we use the recent high, and this gives us our fib range, our fib pocket in here. So look, just measuring this out. So from the high, that would be a almost a 4% pullback. It's around a 5%. It's around 6.5%. So that's sort of our range. Let's say 4 to 6% thereabouts to get down into this fib pocket. That's what I think we could see develop over the next. Maybe it's next week's story. Maybe it's the next couple of weeks. We've just got to see. You can never put a time frame on these things with any sort of precision. It's all just estimates. But that would be a completely normal reaction within with a market which has gone this far. And what we could see, look, maybe that's not even the top. You can't discount the fact the market could pop higher again. But then I do think we're going to see it start to fall into this sort of range down here. Could be over the next maybe 1 to 4 weeks. We want to see how it pulls back, and then we assess what happens then. So is that a precursor for another run up here and a test of these of the all-time high, or does it start to look do we see a sharper move down, then a soft sort of bounce, and then we look for another leg lower? So all options are on the table there. We're just going to watch how this plays out. But I think that's the base case at the moment, that we do look for some sort of pullback in the S&P 500, and I think expect this sort of expect these larger oversized moves to continue at least for the near term, because it's a bit like markets are a bit like a pendulum, in that once they gain momentum, they tend to hold it for a little bit. It takes them a little while to settle down. So like this was a sharp move through here, and this was a sharp rally. Sharp decline, sharp rally, and so you don't get the pendulum just doesn't hang on one side. It goes both ways. So that's why I say the prospect of some wider range days are still very much in there. Now I've got another chart which I want to show you, and it's an interesting chart which also gives look. It's another reason why I'm thinking this pullback is a likely case. Now I just got to find it here because I've got so many indicators, and this is the one. There we go. So this is an interesting one. It is the S&P 500 stocks above their 200-day moving average. Now I'm going to put this onto a line chart because it's a little bit easier to read. I'm going to scrunch it up. Now it's a bit of a crazy looking chart, so don't get overwhelmed with it at the moment. I'm going to explain it all in a sec. Looks more like a seismograph than a stock chart, but it's actually a bit like a seismograph for stocks, because what it's doing, it's showing the volatility, or the extreme moves within stocks, from being very overbought to very oversold. And so what I want to do here, I'm just going to put a bit of a range on. That's about as far back as I can go. There we go. So this is what's that? That's above 90%. So anything in this blue band is showing more than 90% of S&P 500 stocks being above their 20-day moving average. And you can see it doesn't happen that often. These are years down here. So it may only happen once every year or two. It didn't happen here for close to 3 years. And look at this here. Let me just blow that out a bit. That's where we got to earlier this week. We got to 93% of stocks. And so that's a pretty extreme sort of thing to happen. And what you can see when the market has gotten there in previous times, look how quickly it can pull back. It mean reverts back towards, say, 50% or potentially lower. And like all these times through there, once it touches that 93%, it doesn't hang there, doesn't hang in that range, because it's just uncommon to have so many stocks in such a bullish phase. It always comes back. So I don't think this is going to be any different now. I think this is another sign that this market, we are going to see this pull back towards 50%, which means the S&P 500 almost certainly has to pull back as well. So that's my near-term thoughts on the US market. Now, if you're getting value from this video, please hit that like button. Leave a short comment. That really helps as well. It tells YouTube that people are engaging with the videos, they're getting value, and then YouTube shows more people, and I keep making videos when people are watching. So please do those two things. They really, really do help me. All right, let's jump over to the Australian market, because that is interesting as it often is as well. So now let's go back to our bar chart for this. Let's get our scale a little bit better. There we go. Yeah, now I want to touch on this because it's look, I think the ASX 200 is going to get its near-term lead from the US, as it often does, but I think it's looking structurally stronger overall than the US market. Look how close the Aussie market is getting back to these all-time highs. And so look, I actually think this market is setting up to make new all-time highs, which is an extraordinary thing given how people were feeling about the market back here in early February, heading into March. It was a lot of negativity and a lot of fear out there. But look, let's deal with the chart we have at the moment. So at the moment on this chart, we've got double top. We've got the high from August last year, the high from January. So we have a double top, and that's around 7,650. That would be the level for that. Now, some people hear the word double top and go, well, look, that's bad. Double top is bearish. The market can't be strong, but that's not necessarily the case. So often I've seen this sort of structure result in higher prices. I'll show you an example. It's handy when you've got an example on the same chart not too far away, and we do on this occasion. So let's just expand that a bit. It was this period through here. So just through here, it's there we go. There's our double top. We sort of had a double top formation there, and the market pulled back from the double top. Then it rallied back in towards it, paused again, pulled back, and then we had the breakthrough, and the market didn't look back. So look, it plays out differently every time. It doesn't always do that. Doesn't always look like that. And what we have over here, it's going to do its own variation of that. It may not even work out like that. The market could run straight through now, or it could pause here and fall away. We don't know. We're just going on patterns that have, and working on the overall history of how these things tend to play out. No guarantee for now, but that's what I think could be setting up now. So look, I think the best case scenario for this market would be for it to pause temporarily. Like maybe if this US market does have a pullback, maybe we do see the market start to pause around here just for maybe, I don't know, could be a couple of weeks, 3 weeks, we don't know. But then from there, like, it forms a bit of a base, and then it can have another crack at this at the double top, and then potentially it punches through. That would be, look, I've seen this sort of pattern so many times in markets. It's if I'm going to have a base case for the Aussie market, that's what it's going to be. I think the momentum is to the upside. I think the pattern is supportive of higher levels, and this pause fits in with the scenario which we're seeing in the US. So look, let's wait and see. It's this is all, as I always say, this is about possibilities. We're not trying to predict the future. We're trying to identify the possibilities, and then we have our strategies to play those possibilities out. And as you'd know from listening to these videos in recent weeks, I've stayed long the market throughout this period here. A lot of people, look, I've seen commentators talk about going to cash, and people talking about selling up, waiting for the next crash, all this sort of stuff. But the market hasn't done that, hasn't given us enough sign that that's what it was going to do. And if you're using wide trailing stops on your portfolio, like I do with mine, like I do through my Motion Trader service. My Motion Trader service actually calculates the wide trailing stop for people, so they don't need to sort of think about it themselves. If you do that, you can see off these moderate bouts of volatility. Yes, I lost a few stocks in my portfolio through this period, but I've held on to a lot more, and a lot of them are hitting new all-time highs. I would have been kicking myself had I lost my nerve through here and sold everything up. I'd now be up here, hoping and praying the market rolls down to give me a chance to buy back in. And that's what so many people find themselves doing. So one of the things I've been wondering is whether we're going to see some sort of like medium-term rotation out of tech stocks and into the value and resource type plays. And much like we saw in the early 2000s, and this was a period when the Australian market really did outperform, and it outperformed the US market. And I'll show you, this is one of the really great things you can do with this TradingView software. I'm going to show you a ratio of the All Ordinaries, which is XAO, and I'm going to divide that by SPX, which is the S&P 500, and we can use this to look at the relative strength of the two markets. Now I'm going to put it onto a weekly to make all the magic happen on this, and so this goes back to 1981, and so what's happening here? When the ratio is rising, the Australian market's stronger. When it's falling, the US is stronger. Aussie market stronger, US stronger. Okay, so we've got two big periods where the Australian market has done stronger than the US, from 1983 through to the 1987 stock market crash, and then from 2000 when the internet bubble blew up and the tech stocks went into a downward spiral. And we also had a resources boom and a value stock renaissance. That all happened through this period here. And then from the GFC, it's been all US and tech, and the Australian market has lagged. So I'm wondering whether we're getting close to another one of these periods. Like this is longer term sort of stuff. It's not a prediction for next week by any stretch. It's just a wondering, a pondering, and a potential understanding possibilities, so you can position yourself in stocks which could benefit. And this is interesting as well. Let's put it. I'm going to put. You can find this. If you use TradingView, go to patterns, and you can find time cycles. This is here with all the Elliott wave stuff. Let's get time cycles. This is just for fun. It's not a prediction by any stretch. But you can and it's also like a best fit sort of exercise. So let's do that. Can I pull this across a little bit more? Yeah, there we go. So I'm just doing some best fit stuff with this. That's best fit. Okay, so you can see how these are quite. They do these big moves. They operate in cycles. So we had the up cycle. Then we had the down cycle, doesn't match up perfectly, never does. Had another up cycle, had another down cycle. So you'd say, the next up cycle is probably due. But look, again, this is like 4 years between these points. So there's a lot of margin for error in your timing. But we are due some sort of cyclical upturn in the Australian market versus the US. Just something interesting in passing to keep in mind. And you can do this yourself with TradingView if you have that. And it's interesting. I've been getting buy signals through my Motion Trader surface recently for stocks in agriculture, retail, resources, been value plays. While many of those previous favourites from the pandemic, a lot of those are still struggling, and a lot of those tech names. And just to give you an idea of tech, this is this ARC Technology ETF in the US. It's all there's it's a lot of tech stuff which doesn't make money. So it's all based on great things tech could do in the future, great in the bull market. But just look at this. This stock is off, and this is typical of a lot of the stocks which did well during the pandemic period. Like this is off close to 70%. So it's I think we're seeing rotation away from tech and into new names. So the big winners in the last cycle may not be the big winners in the next one. So just something to keep in mind. Now I want to jump over and have a look at gold, because this is all looking really interesting. So here's gold here. So okay, let's talk through this, because this is a bit of a classic setup that we have at the moment. It's really interesting. It's one of the most exciting charts I've seen for gold in a long time. And so what we have is one of the best asymmetric risk reward profiles which you really get to see on a chart. Now that doesn't mean that it's going to be profitable and it's going to work and it's going to go up. It just means that the risk reward is highly favorable, and when they work, they can work really well. When they don't work, they don't do too much damage. That's the idea. So let's set the scene. So we had the breakout here. We had this 12-month trading range, and we got the breakout about 6 weeks ago. And this was significant because this is the first time gold's really had a good momentum run outside of a range since back here, as we were leading into in mid 2020, as gold was finishing that leg of the bull market and heading towards its peak. And now the second key event we've had just in recent times is we have, and we were talking about these earlier, probably recognise the pattern, the double top. We've got the double top there, and now, again, people think double top must be bad, but look, it all depends what happens below the top. Sometimes these turn into large topping patterns, and they sort of just meander around and then slowly start to roll over and then go into a long bear market decline. That can happen from a double top. Another possibility, and we kind of looked at this with the ASX 200 earlier, is that, and this is what I think could be happening with gold. Another possibility is that the market starts to, stabilizes around here, builds some base of support, then starts to move higher, regain its momentum, and then punch through to the upside. Should it do that, well, we could really see some strong upside momentum in gold over the next 1 to 2 years. So it really is one of those key pivot points. But it's so crucial that gold holds its footing here and doesn't start to cave back into this range, because if that happens, well, I've got a bearish alternate for that, which sees us back down here. But this is what risk management is all about. We can put levels in place where we're exiting well before the bad stuff happens. So let's work through this a bit more. Another good thing to do, let's put the Fibonacci's on. So let's use the recent low. So this was a January low and the recent high. And you can see that just this week, gold's come back to the 61.8% retracement, which is, look, so far this is textbook stuff. Had the strong move up, we've had the return move, it's pulled up in the fib pocket, we're bounced off there, we can also put on, another thing we can do, let's put our moving averages on, and you can see it's also come back to the 50-day moving average, and is the 100-day moving average is coming up below there. So this is sort of like, I think for the near term at least, it's make or break time for gold. You've got all the reasons for buy the dip to happen here. You've got the fib zone, you've got the moving averages. This is where traders who want to buy the dip need to show up and buy the dip, support gold, and then let that upward momentum re-engage and kick it higher. That's the bull case for gold, and it's look, I think it's an exciting one because, you know, from a risk reward perspective, you know, if you wanted to aggressively play gold, you could put a stop loss just below this week's low, and that's only about 2.5% below the current price. My preference, if I were going to buy gold here, and I've already got plenty of gold, probably don't want any more just at the moment, I'd probably go for like a 5% stop. I'd probably give it down to here, you know, see it come back down, get back within this range, and I'd go, well, look, it's not now. It would be sometime in the future. Sometime, you know, it could be many months away if we see gold get back down here. But for now, we've got the break. I think we've got to give the bulls the benefit of the doubt, and we've got to play it from the upside. It's you know, my biggest concern is this was a catalyst-led rally, all about war in Ukraine. And the problem with catalyst-driven rallies is they can sometimes quickly lose steam and then just collapse back in on themselves. So this is why I say gold can't lose its footing here. If it loses footing here, well, it does open up possibilities down here. But that's not the case at the moment. It's holding firm. Let's see if it can continue doing that. Let's see if it can kick higher. And it could be, you know, we could be getting close to, you know, gold's day in the sun. It's been an 18-month correction or consolidation to sit through, but it could be time. So let's leave it there for today. Hopefully you enjoyed that. Hopefully you got some good value. Please hit that like button. Leave me a short comment. Look forward to coming back and joining you again next week. Thanks for tuning in. Until later. See you then.